Hello, everyone, and welcome to the first Q&A with Pekka, Marco, and Nishant. This session will run for 30 minutes. As a reminder, we will have a second Q&A session later today, following the business group presentations. If you have any questions that are clearly business group specific, I would like to ask you to consider saving those for the second Q&A session. Two more things from me. First, please limit yourself to one question only, as a courtesy to everyone else in the queue. Second, please remember to unmute your microphone and turn on your video after we place you into the live call. So without further ado, let's start the Q&A session. Please raise your hand if you would like to ask a question. And again, once you are brought into the live call, please remember that you will need to unmute your microphone and turn on your video. We'll take our first question from Sandeep Deshpande from JP Morgan.
Hi, thanks for letting me on. Pekka, I have a question in terms of how you see the nearer term compared to 23. I mean, you are dealing with, in the short term, share loss at some of your major customers. And so will we see that progression towards revenue growth in 22, or is this still going to be weighing down on your sales, and that really beyond 22 is when we will see that growth beyond the market growth?
Thank you, Sandeep. And of course, we are not providing detailed guidance for 22, so I will basically comment 23 when as we said that our target is then to grow faster than the market. But I still want to give you a little bit more context. Of course, this will be in a way a year of reset, and I'm very encouraged with what I'm seeing both on the technology side, and you will hear from Tommy about the progress on his 5G turnaround roadmap. But perhaps even more importantly, the recent deal flow that we have had. You will have seen the T-Mobile deal in early this year, then CNS-led deals with all major web scales. We have increased market share in IP routing, now later in optical networks also in Europe. And then on top of everything, the very important 5-year 5G C-band deal with AT&T today. So this means that I'm growingly encouraged by our situation, and I certainly hope that this, in a way, hit that we took this year because of the earlier decisions by some of the customers, that this will truly be a year of reset, and then we will start to see improvement already next year and not have to wait until 23.
Thank you very much.
Thank you, Sandeep. For our next question, let's go to Dom Olszewski from Morgan Stanley.
Yes. Afternoon, everyone. Thanks for taking the question and for the presentation. On mobile networks, previously, you've obviously talked about the Reef Shark deployments, which are expecting to reach 100% of shipments by 2022. And that was to drive lower product costs and improve your margins. And obviously, you're guiding to 5 to 8% by 2023, while your main peer is in the mid to high teens. So could you bridge us to explain what the delta is and what has to improve in order for you to hit that range?
First of all, you have to look at the trajectory between this year and then 2023 in mobile networks, and it is quite a significant improvement. And of course, we have not said that what we expect to achieve in 23 would be the ultimate target, but we have to be realistic as to how quick the improvement can be. And as I was describing in my presentation, we do believe that the peak of the 5G market will continue quite a long time, and it will be driven by the digital enterprise opportunity, and 70% of world's enterprises investing in 5G and so on. So all that makes me pretty optimistic about our 5G situation. And when you compare us to the competitor that you referred to, it's always important to keep in mind that there are some reporting structure differences. They are reporting some of their IP licensing business together with the networks business. If we were to report in the same way, our mobile networks profitability would be significantly better already today compared to what we are reporting.
Can I just build on what Pekka said? I think that if you listen to Tommy's presentation today, you will hear some more ambitions from Tommy as well, and you will get some more flavor on this as well. I think that Tommy will give a little bit more ambitions beyond 23 as well. Just a cliffhanger here.
Very good. Thank you, Dom. Let's take our next question from Alex Peterk at SG.
Yes, hi, thank you. Thanks for taking my question. I'd just like to understand regarding the restructuring impact on your P&L. Are you going to actually reduce your OPEX at all, or is it going to be broadly flat or perhaps even rising as you seek to reinvest into R&D, and at the same time you have also OPEX inflation? So is basically all of the operating margin improvement going to stem from improved gross margins and economies of scale? Thanks a lot.
Yes, thank you. As we said 2 days ago, what we are really doing is that we are in a way making room with the cost reset. We are taking advantage of the new simplified operational model, and this way creating room for additional R&D investment, because it is so important to be able to invest more, not only in mobile networks, but also in some other parts of the businesses. So in relative terms, in our OPEX, in our personnel, the relative share of R&D of the total OPEX will increase. So this is kind of the high level picture, but then Marco, if you want to give a little bit more color on how the numbers will look like.
Yeah, thank you. Yeah, as we are now guiding, we are saving about 600 million during 2021 to 23. And at the same time, we are increasing our investments in R&D, like Pekka mentioned, and also capability shift, and also we have the inflation. So we have areas which are increasing costs, but we are being able, with this cost-saving program, to invest in these areas. But if you look beyond 2023, when we have received all of these savings, then actually the cost base is all other items equal, actually lower 600 million than it would have been if we wouldn't have done this cost-saving program.
Thank you, Alex, for your question. For our next question, let's move to Daniel Djurberg from Handelsbanken. Daniel, whenever you're ready, please go ahead.
Thank you so much. Unfortunately, my video seems not to work, but hopefully you can hear me.
Yes.
Yes, that's great. I was wondering if you can comment a little bit on the mobile network gross margin outlook for 21, 22, and possibly also 23 in terms of improvement and impact on pricing issues this year. Thank you.
You will actually hear in Tommy's presentation information and assumptions around the different parts of the P&L development, and of course our general ambition level when the product competitiveness increases is that would then be reflected in the gross margin as well. But what we have decided quite clearly is that we do not guide separately on gross margin. We are just commenting the operating margin, which is then of course the product of gross margin and OPEX.
Yeah, that's fair enough. Thanks.
Thank you, Daniel. Appreciate your question. Let's take our next question from Richard Kramer at Adete.
So Pekka, you're now on Nokia restructuring maybe 3.0 or 4.0 since the Alcatel merger. And I guess when we look at the past plans, however well-intentioned that they didn't deliver sustainable cost cuts or higher profits. So, and oftentimes they destabilized the organization such that you had to make catch-up investments in R&D. I guess my question is, what is materially different this time? And specifically, when you talk about accountability for the business units, and equally you mentioned all your enthusiasm for private networks, how are you going to address an area like enterprise, which cuts across business units? No one seems to have specific responsibility for that, and yet it seems to be a big part of your future growth. Thanks very much.
Thank you. Of course, I do not have all the details about the previous restructurings. I have been here only a few months, but what is really important this time now is that this is not only cost cutting. This is much more strategic. First of all, we are changing or have changed our operational model. Significant simplification, removing many of the matrix complexities that we have. Management team from 17 to 11. We had a management team structure where it was pretty unclear in some cases that who should make each decision. Now it is crystal clear. The BGs have full accountability. So we are simplifying the operational model, and that is structurally enabling us to take out costs from certain parts of the organization. And we are reinvesting a lot of that money then in R&D, because the important thing here to understand is that when you look at our performance over the past few years, we have had good pockets of performance and bad pockets, and overall, I guess on aggregate, we cannot be happy with how things have gone. And there is a very direct connection between product competitiveness and the gross margin for that product, and then overall profitability of that particular unit. And that's why it is extremely important that in those cases where we still have subscale performance, that we find a way of becoming either number one or number two in technology. That is the only way to drive gross margin. That is the only way to drive profit. And that's why we are now doing this structural change through the operational model, where we are taking out cost from somewhere else and putting it into R&D. This is really the biggest difference as I see it compared to the previous models that we have had.
Thank you, Richard.
Sorry. I forgot. Hey, Matt, sorry. I forgot to answer the second part of the question, which was the enterprise, because of course we are pretty bullish about the potential of the connected digital enterprise, where of course private wireless is one part. And yes, our business structure is solution based. So we are not structuring the business groups around the customer groups. They are structured around technologies and solutions, and all of them will be selling to different customer groups. But what we have done is that we have created one integrated sales force for enterprise customers that is pulling together the solutions from the three BGs. This sales force is organized under the Cloud and Network Services business. It is one sales force going after the enterprise customers, adjusting to the clock speed that the enterprise customers need, which is often a different clock speed from CSPs. And then financially, the end result will be reported in the three BGs, depending on which part of the solution we are selling.
Thank you.
Yeah, sorry about that. Thank you, Richard. For our next question, let's go to the line of Peter Kurt Nielsen from ABG.
Thank you very much, Matt. I seem to have some issues with my video. Thank you for the presentations and for the opportunity. I'd like to return to the issue of return on capital employed, please. The more than 7% target over time does not seem overly ambitious. Can that be reached through the 2023 targets, which you have outlined? And perhaps could you elaborate on longer term ambitions for that and the impact of and scale on this and where that would leave you sort of going forward? Any elaborations on this would be much appreciated. Thank you.
Thank you. We have actually guided today also comparable return on capital employed at the group level. So for 2021, we've said between 10 to 15%, and for 2023, we've said between 15 and 20%. And the 7% is only a cost of capital that the group has today. And of course, each of businesses, we will assess what is the maximum opportunity we see there and set the targets based on their circumstances and opportunities as well. So we definitely are driving higher returns than the cost of capital, and this is not another maximum ambition level that we have.
Okay, may I ask a follow-up relation to the outlook? At the strategy update in December, you provided some indicative margin guidance for the business areas for 21 and also longer term. I guess that 23 does not qualify as longer term. So are we to understand it that you do see further upside to long-term margins beyond 2023? Thank you.
Yeah, now we are focused on guiding for 2021 and 23. And if you listen to each of the BG's presentations today, I think that you will get some more flavor on as well where we are. And as we've said many times, the technology investments are extremely critical here. And we believe that we have a very good foundation to be a leader in these areas.
Okay. Thank you very much.
Thank you, Peter Kurt. I believe the next question will come from the line of Artem Beletsky from SEB. Artem, if you're there, please go ahead. Artem, can you hear me?
Yes,
Perfect.
yes, I
Please
can.
go ahead, Artem.
I would like to ask further on stepping up R&D investments. Could you maybe talk about key areas where you will be increasing investments going forward, and maybe continue on the same topic, what comes to mobile networks, do you still expect that this year will be basically a peak in terms of R&D spend?
Yes, thank you. I will ask Nishant to get into a bit more details. But of course, when we talk about the R&D investment, the biggest increase is really in Tommy's 5G R&D. And then, of course, yes, I understand the question that when will it peak? When it comes to the FPGA R&D, which is one part of it, I mean, that will come to an end development-wise when we complete the SoC program. And as you know, the target is 100% deliveries based on SoCs by the end of next year. And that means that then the FPGA part of the development can be ramped down, with the exception of some maintenance. Then the overall R&D, we are not currently guiding separately, because it will then move on how it will depend on how much opportunities we will see in other businesses and what other segments we are going to invest in mobile networks. That's why we are only guiding the operating margin, and the expected R&D investment is now embedded in the 2023 guidance. But Nishant, why don't you comment a little bit the most potential R&D investment areas going forward?
Yeah, thanks, Pekka. And here it's about having a very targeted approach. Within mobile networks, of course, the focus here has been to invest on the silicon side of things for system on chip. There's also been a focus to invest on critical areas like L1 and linearization software for radio. Very important for not just catch up, but leapfrog. Within cloud and network services, it's really around the strategy of digital orchestration, security, and automation. And for NI, here it's about data center switching. It's about also orchestration and automation and control platforms. And finally, for our long-term investments that we do within Jenny's BG on technologies, is about device-centric investments. You will see two big trends: software increasingly becoming important across the BGs. And I would also highlight that we've started investing on early research on 5G evolution towards 6G.
Thank you, Artem.
Yeah, very clear. Thank you.
Yeah, thank you, Artem. Let's take our next question from Simon Leopold at Raymond James.
Thanks for taking the question. I understand and appreciate the pivot in operating expenses in favor of R&D, but what I'm really seeking is maybe a clear understanding of what are the sacrifices Nokia will make. In other words, what is it you would have done that you're no longer going to do in these efforts to restructure and become leaner? Thank you.
Well, when we are removing the matrix structures and simplifying the organization, that makes it possible to rationalize layers of the organization, simplifying and increasing cost efficiency of support functions, administration, and so on. R&D is something that we are protecting. We are increasing it. The customer interface, the key salespeople are also, of course, in an extremely important and crucial role. But I would say that everything else, everybody else, everything in the organization, not R&D, not taking care of the customer interface, we have identified a lot of opportunities to improve cost efficiency. And then also, as you will hear in the BG presentations, even though we are saying that we are increasing R&D investment to go for technology leadership, there is opportunities to rationalize the product portfolio and reduce R&D in products which are getting closer to the end of its life cycle. So the R&D investment, even though we are talking so much about that, that does not mean that there would not be possibilities to optimize, rationalize, and scrutinize that either. But the general name of the game is that we are taking cost out from everything else but the customer interface and R&D, and then investing it in mostly R&D. I believe that we have evidence of that the customer interface, the sales organization, the account teams that we have, that's a really, really high quality organization. I do not see that being a bottleneck. On the R&D side, yes, there have been bottlenecks, and this is how we are creating funding for that.
Thank you.
Thank you, Simon. Now let's try to take Stefan Slowinski's question once more.
First of all, thank you to Pekka and Marco and Nishant for the presentations. And just a question for Marco around cash flow and the profile of the cash outflow for this newest round of restructuring. You still have the 500 million left over from previous rounds. Will the cash outflow for the current new restructuring, will that match the P&L charges? I'm not sure if you've provided that yet. And along the same lines, in terms of cash flow from now to 2023, do you expect any changes in the technologies group and the cash conversion there from EBIT to free cash flow, and how that could impact cash flow the coming couple of years? Thank you.
Thank you, Stefan. What comes to the restructuring, as you mentioned, we have the 500 million, and about half of that will be in this year's cash outflow. The new program, we have guided that about the same amount would be impacted this year's cash flow. And then what comes to later years, we haven't actually guided yet, because we have to see also with those countries where we have works council negotiations, how those negotiations are going, and what is the pace of those. And then we will give you more guidance when we know that. What comes to the technology and cash flow versus EBIT difference, as we've guided now for this year, it's about 600 million difference. Going forward, it depends totally on what are the deals we are signing and what is the cash flow timing issue in those deals. Some deals could be so that we get some prepayments, but then we might have deals that we don't get any prepayments. It will follow the OPS, operating profit, as well. So it's very difficult to predict yet. But here as well, I promise we will give you guidance when we have more visibility on this issue.
Thank you, Stefan.
Thank you.
Thank you. For our next question, let's go to Amit Harchandani at Citi.
Hello, everyone. This is Amit Harchandani from Citi, and thanks for letting me ask a question. I would like to go back to the topic of gross margins, please. I must admit, I'm still not clear why you would not like to guide specifically on gross margins, given it's such a key metric that investors look at. But at least qualitatively, could you give us a sense for what are the most critical drivers that would drive the uplift in gross margins? Is it lower cost of product, exit from lower margin contracts, any other avenues? So anything you can share with us to help build a trajectory for gross margins over the next 3 years would be helpful. Thank you.
Thank you. That's an excellent question, and of course, I mean, in the big picture, why are we investing in technology leadership and in number one or two technology position in those segments where we have decided to compete? The fundamental reason for that is to drive gross margin up, because the technology position, first of all, it gives you pricing power in the deals that you are making, so you get higher prices. But then very importantly, as you will see, for example, in Tommy's presentation later, when we are proceeding in R&D, that is lowering the cost of goods sold, the cost of the product. And then, yes, especially in Raghav's business, in the new structure, there is still some old lower gross margin contracts in the services business that we are rationalizing at the moment. So actually, this is an excellent question. It's all of those together. We have decided to guide on top line and then operating margin for the businesses, but we have decided not to provide more granularity than this, and I do not believe that this is that untypical on the market. But the ambition, I promise, is very clear, that through the technology investment, our ambition is to drive gross margins up.
Thank you, Amit. And for our final question for this session, we'll go to the line of Andrew Gardner from Barclays.
Good afternoon. Thank you for taking the question. I had another one sort of on a related topic in terms of R&D and leading to that gross margin competitiveness that you were just talking about, Pekka. You guys have talked about returning to industry leadership in technology, but I'm just wondering about your relative levels of competitiveness within R&D. You haven't been specific in terms of, sort of the R&D levels as we look out a few years, but it feels like you're still going to be about a third below where Ericsson would be on a comparable basis. Who knows exactly what is going to happen with Huawei, but they clearly are investing more as well. So what is it about sort of the current plan that is giving you the confidence in indeed getting to a number one, number two position in terms of technology with a much leaner R&D budget? Thank you.
I will ask Nishant to comment this, but before he does, I will comment on a general level, and then of course the business groups will zoom into this in their particular parts. But this has a very important connection to the operational model now, and this is to some extent different from the past. That when we say that ABG is fully accountable for the business, one of the key reasons why we made this change was that we wanted to create a direct connection, accountability-wise, between the significant R&D investment, 4.1 billion euros last year, and what we produce with that all the way to the customer interface. In the previous operational model, this accountability was not clear because it came to the leadership team and ultimately to me through two different dimensions in the organization. Now the responsibility is in the same hands. Whoever is responsible for the R&D investment and has the R&D budget is also responsible for the success of the product in the customer interface. And as I said earlier, if we have products or segments where we do not see a path to leadership, then we will assess our options. Nishant.
Yeah, I think it's first, without commenting on competition, I'm not sure if that's sort of the difference in R&D intensity on the group level. But if we specifically look at I can speak from experience. The biggest bang for the buck is when you know what you're going to build. Target active portfolio management gets you the best returns, and that is a big focus for us as a management team. The second piece is actually R&D intensity. So you're investing enough. And then we find the right nuggets. We feel that there is adequate investment behind. We're solving the bottlenecks. I talked about some of them. We're solving for where we really needed extra hands and feet behind them. Finally, it's about R&D productivity. And that has many facets to it. It's about digitalization of processes and tools. In aggregation, I would say we as a management feel rather confident between the right portfolio choices, sufficient R&D investments and intensity in the right targeted areas, and the right R&D productivity curve, which we have seen over the last 2 years, especially in MN. We feel that there is enough muscle to take the 1 or 2 spots that Pekka talked about in each of the businesses.
Thank you, Andrew, for your question. And thank you again to everyone for all of your questions for this session.